Moderator CA Hitesh Gajaria, Vice President Mihirbai Sheikh, Chairman of International Taxation Committee Dr. CA Mayurbhai Nayak, other office bearers, seniors and friends. A very good evening to all. BCS is in its 73rd year and continues to deliver quality service to the profession. Those who are not members of BCS but are CA, I would request them to visit BCS website and spend a couple of minutes to gauge the scale of programs and events for professional development which BCS has to offer. This will enable you to assess what you will be gaining by being part of BCS as a member. For all who are non-CAs, I would request them to subscribe to our prestigious BCAJ, which is considered a treasure trove for the professionals. This year's theme for BCS is ESG, empowering, scaling and globalizing. Our endeavor will be to bring offerings which will cater to each aspect of the theme. This lecture meeting on taxation of digitized economy is towards empowering our members with the knowledge of upcoming changes in international taxation. This also provides the professionals to have an outlook for global minimum tax regime, which is unfolding. Coming to the topic for the day, we have been governed by the international taxation rules, which had been framed more than a century ago, with refinements as economies and businesses progressed. The basis of the rules determining taxability have been nexus of physical presence and profit allocation on arm's length principle. With the advent of digital economy, the entities can operate in multiple jurisdictions without having any physical presence. With such developments create issues of determining taxability for the entities which carry on business in jurisdictions without physical presence. Recently, G7 finance ministers and central bank governors, through their committed to reach an equitable solution on the allocation of taxing rights. Further, the OECD on 1st July 21 issued a statement on a two-pillar solution to address the tax challenges arising from the digitalization of the economy. The OECD G20 inclusive framework on BEPS has agreed on implementing a two-pillar solution to address tax challenges from digitization. This data shows that both the digital business and tax issues arising from it would grow multifold. Recently, the Indian government has tried to bring digital businesses within the tax ambit by introducing charges such as equalization levy. However, we all know the challenges that everyone is facing due to the scope and method of levy. There have been concerns expressed by several foreign countries and requested India to have a relook. India has also introduced the regime of taxation based on significant economic presence. To debate and understand taxation of digitized economy under Pillar 1 and Pillar 2, we have today with us an eminent expert on this subject, Mr. Akhilesh Ranjan, who would be clarifying many of the nagging thoughts in the minds of professionals with respect to the modalities of allocation of taxing rights within the jurisdictions in which multinational entities operate and jurisdictions where they operate and have their physical presence too. We also have an equally able moderator in Hitesh Gajaria, who would ensure that all the pertinent issues which needs to have a clarity are put before Mr. Akhilesh Ranjan to provide effective guidance. We all are in for a very interesting session for the next 75 to 80 minutes. I would now request Chairman, International Taxation Committee, Dr. C.A. Mayur Nayak, to briefly introduce the speaker and moderator. Thank you very much.
Thank you, Abhay, and good evening and welcome to all of you. I am indeed privileged to introduce our today's speaker, or the expert on the subject, Mr. Akhilesh Ranjan. Mr. Akhilesh Ranjan is a tax policy specialist. He was a member of the Central Board of Direct Taxes, Government of India, in charge of the tax policy, legislation and international taxation till his recent retirement in December 2019. Having served in the Indian Revenue Services since 1982, he has a rich experience of direct tax policy formulation and administration in India. He has served as the competent authority under India's tax treaties and also functioned as the chair of the working group on tax policy established by the G24 group of developing nations. As convener of the Direct Taxes Task Force constituted for rewriting the tax law, he has submitted a comprehensive report together with a draft new income tax code to the government in August 2019. Post his retirement, he also acted as consultant to the OECD, rendering strategic advice and technical support to the OECD Center for Tax Policy. Friends, let me tell you that when we approached Mr. Ranjan for this talk expert chat, he immediately agreed. He is always willing and eager to share his expertise and knowledge with the professionals. Very humble, nice person, a fine human being, Mr. Ranjan, and he has represented India at various forums, including OECD and international forums, and uh, contributed a lot in the arena of the tax policy making. Welcome, sir, to this expert chat. Thank you very much. I have a pleasure of introducing our colleague, CA Hitesh Gajaria. He has over 36 years of professional experience in the fields of tax, transfer pricing, regulatory consulting. He is a senior partner at KPMG in India, having led the firm's tax regulatory service practices from 2018 to 2020. He had earlier also led the firm's transfer pricing practices and was a tax leader of the firm's industrial and consumer markets vertical. Friends, Hitesh Bhai's achievements are, many more. For the paucity of time, I would only say that he's an active core group member of the Bombay Chartered Accountants Society, a dear friend, a member of the International Tax Committee since inception, and he has contributed to various organizations, world across in the field of international taxation, FEMA, transfer pricing, and various other aspects. One more aspect of his personality is that he's an excellent singer and a regular figure in our RRC. We are missing your singing, Hitesh Bhai. Maybe in near future, we would request you to do so. So with this, I introduce Mr. Hitesh Gajaria and now request him to take the charge of the session. Thank you very much.
Thank you, Mayur Bhai, for that generous introduction. Thank you, Abhay Bhai, Mihir Bhai. And indeed, I am again thankful to the Bombay Chartered Accountants Society for having given me this opportunity to learn this subject. This is embellished by the fact that I have with me Mr. Akhilesh Ranjan, who Mayur Bhai could only very inadequately describe when he said that he is such a humble person and he is willing always to share his knowledge. I've had that experience myself, and therefore I feel at least on this topic, we would not have had a better panelist. The idea is, sir, in BCAS, this is always a closed door meeting, but we always share adequate information so that the members are better equipped in their practice. And in fact, this is now a complete sea change in the way the world is going to see tax principles almost on their head. They will be turned, and without much ado, I'm going to start by giving a small introduction of what this entire topic is. I will be making a small presentation. I will be later on sharing this presentation also with the BCA's office bearers so that they can share this with all of you. With that, I'll just start my presentation. So what we are looking at really is the new taxation of the digitized economy under Pillar 1 and Pillar 2 by the OECD. And these are the topics we are going to look at, obviously, introduction, Pillar 1 and Pillar 2. So basically, if I were to sum up, what are the two pillars all about? Pillar 1 focuses on allocation of taxing rights between jurisdictions, new profit allocation and nexus rules, not those which we have been traditionally been following, that is residence and source rules, but absolutely new nexus rules. This approach seeks to accommodate the new business models and tries to find a way forward to tax these new business models. And it seeks most importantly to expand the taxing rights of market jurisdiction, that is where the users of such digitized goods and services are situated. Notably, India, with its very vast population and a huge user base, is expected to benefit from these new proposals, but Mr. Ranjan will tell us more about that. The OECD statement, however, indicates that the regulated financial services sector, including insurance and the extractive industries of mining, etc., are going to be scoped out of the ambit of Pillar 1. Pillar 2, on the other hand, is more broad and all-encompassing. Pillar 2 is also known as the GLOBE proposals or Global Anti-Base Erosion proposals. And it seeks to address all the issues which remain apart from the issue of taxing digitalized businesses. This is a coordinated set of rules to address profit shifting and to prevent unhealthy tax competition, which jurisdictions have been doing thus far to attract foreign direct investments. And basically, they rest on the principle to tax back where other jurisdictions have not exercised their primary taxing rights, or if the income is subject to a very low rate of tax. This Pillar 2 is therefore proposed as a top-up tax to a minimum effective tax rate, which is going to be agreed between all the countries in the inclusive framework. And the idea is to provide a level playing field now for both tax jurisdictions as well as for taxpayers. So let's look at Pillar 1. Now, this OECD declaration on 1 July is actually materially different from the one they had given in October of 2020. So it helps us to understand what the new proposal is all about. The new proposal talks of Amount A and Amount B. Amount A is that portion of a multinational enterprise's deemed residual profit, which will be reallocated to the market jurisdictions, obviously for them to levy a tax thereon. It will be applicable only to large and most profitable businesses. And the Amount B is a fixed return for certain routine marketing and distribution activities in the market or the user jurisdictions. And it will apply to almost all businesses. Now, this is a marked change from the October 2020 proposals, where they had spoken of the deemed reallocation only in the case of two types of businesses, which were automated digital businesses or automated digital services businesses and the consumer-facing businesses. However, what we see now are that those two concepts have been done away with. They will apply to almost all the very large and most profitable businesses. Another important factor of the entire proposition is that there must be wedded along with this new proposal the concept of absolute tax certainty through possibly a mandatory dispute prevention and resolution mechanism, and again, which will apply to all businesses. So let's understand a little more in detail what Pillar 1 entails. They are first talking of who are the in-scope multinational enterprises. Now, these are, as per the new guidance, those multinational enterprises who have both a global turnover exceeding 20 billion euros and who also have a profitability about 10%. That is measured as profit before tax to revenue on an accounting basis. It is stated that after 7 years, after this new proposal takes hold, and assuming it takes off successfully and it holds successfully, this threshold is proposed to be reduced to 10 billion euros. However, as I earlier explained, what are clearly excluded are all extractive businesses and regulated financial services. So what is going to be the profit which is going to be reallocated? And let us understand it in two baskets. One is, first of all, what is the calculation of the taxing rights? So what is proposed and agreed by 130 out of the 139 nations of the inclusive framework is that any profitability in excess of 10% will be deemed to be residual profit. And again, the same 10% is measured as profits before tax to revenue on an accounting basis. Once you arrive at that residual profits, which is over 10% of revenue, then between 20% to 30% of that residual profit will be allocated to market jurisdictions, with the nexus for taxation being revenue-based allocation keys. Profits will be based on the financial accounting income, subject to very minimal adjustments, if any, and allowing for carry forward of losses. What is understood is that the nexus rules will kick in if the country sourced revenue threshold is met. And currently it is proposed that a very low threshold of only €1 million in any jurisdiction will be the threshold test to satisfy if there exists a nexus for that country to tax such additional deemed residual profits. However, for very small countries, if the GDP of that country is less than 40 billion euros, then the threshold will be further lowered to only 250,000 euros. There are going to be prescribed detailed revenue sourcing rules for specific categories of transactions, and therefore one needs to wait and see what sort of revenue sourcing rules will be put out there for everybody's understanding and clearing the way for such market jurisdictions to tax such deemed residual profits. And again, the application of the arm's length standard, however, to amount B, that is routine marketing and distribution activities, again will be simplified and streamlined by the end of 2022. What is also clearly mentioned there as a necessary conjunct to the new proposal is the entire promise of tax certainty and implementation. So all the 130 countries which have signed up have in a sense committed to binding dispute prevention and resolution mechanisms for issues which relate to this amount A. And generally, this will be mandatory. However, consideration will be given to making them elective for certain developing countries for a certain point in time. Simultaneously, there is the promise that all unilateral measures of taxation which various countries have put in place in their domestic law will be removed, such that equalization levy, for example, in India, or digital services tax in France will also be removed. The implementation will be done via a new multilateral instrument. This again will be developed and will be open for signature in 2022, with the amount A coming into effect in 2023. Let's quickly look at Pillar 2. Pillar 2, as I told you, takes care of all the remaining concerns that BEPS had apart from the digitalized businesses taxation. The objective is really to ensure that large internationally operating businesses pay a certain minimum level of tax in every country that they operate. And therefore, the design considerations which went into the making of such a Pillar 2 were that you disincentivize any tax-driven profit shifting, you address unhealthy tax competition, or what most commentators have called in the last 30 years the unhealthy race to the bottom. avoiding double taxation or taxation where there is no economic profit, and minimizing administrative and compliance costs. The framework therefore envisages such rules which give countries a right to tax back certain incomes. And collection of a top-up tax is envisaged where income is not adequately taxed. And later on, I will take you through a couple of examples which will demonstrate how this will work. Rules, it is important, will have to be implemented through changes to both domestic law and tax treaties. So let's look at what does this entail. And these are, in a nutshell, all the components of Pillar 2, given a high-level overview of that. So right in the center is if income is not subject to tax at a minimum effective rate of tax, then what will happen? Step 1, first, there is a subject to tax rule. Therefore, a payer of such income to a country which does not have that effective minimum rate of tax will need to collect a top-up withholding tax if the recipient of that income in the other country is not adequately taxed. Then there is the income inclusion rule, what I have called 2A, where the ultimate parent entity, that is the tax authority of that ultimate parent entity, collects a top-up tax if the overseas subsidiaries are not adequately taxed or not taxed to the extent of the effective minimum rate which is agreed. Next step is the switchover rule. Again, this is not forming part explicitly of this final consensus, but this was discussed in the October 2020 press release. We'll have to see whether this forms part of the final rules as are prescribed. This is the switchover from an exemption regime to the credit regime if branches are not adequately taxed. And finally, there is the under-tax payments rule, where the deduction for related party payments will be denied if the ultimate parent entity does not collect a top-up tax under the income inclusion rule. So in a sense, the income inclusion rule as well as the under-tax payments rule, read with the switchover and subject to tax rules, will act like a self-regulatory mechanism such that no income finally is able to escape tax at a rate which is less than that which is the effective minimum rate which is agreed. So what are the subject to tax rules? For example, I told you it allows the countries to levy a top-up withholding tax on covered related party payments if those are taxed below a minimum rate in the related parties countries. And they have laid down specifically interest, royalties, franchise fees, payments to use intangibles. Now, intangibles has a major area of focus, and that clearly is something which the tax authorities have recognized as a means to shift profit away to low tax jurisdictions. What is also important is that under consideration currently is also capital gains, which is not subject to tax in either country, either due to TT protection, etc. And here perhaps the hint given is that this may not even require the parties to be related or connected parties. So here let's take a practical example. If an India company is making payment to a Dutch company, and if that income in Netherlands is not adequately taxed, then as a covered payment, the trigger rate, which is expected to be between 7.5%, will trigger in, and therefore this will allow India to levy a top-up withholding tax when such payments are made. Let's look at the concept of both the interlocking rules, income inclusion rule and the under tax payments rule. And let's look at it by way of a practical example. The UK company has two subsidiaries, one in India and one in Luxembourg. I'm just presuming that Luxembourg company has a low effective tax rate. Now, what will happen is that primarily UK has the first right to levy the top-up tax under its own income inclusion rules for all the payments that the Luxembourg company receives from India. But if UK fails to include such income in its income inclusion rule, then India will get a right to collect a top-up tax by denying the deduction on such payments to the Luxembourg company. But that is contingent only on UK not levying any tax by not including such income that the Indian company gives to the Luxembourg company in its own income inclusion rule. Now here again, it is important to note what are the prerequisites. There is a euro 750 million group revenue threshold. But again, what is mentioned is that for the income inclusion rules, countries will have the flexibility to even use a lower threshold and effectively make this rule much more stringent so far as its own residents are concerned. Income of the group entity is taxed at below the minimum effective rate. Now, currently, the minimum effective rate being proposed is not less than 15%. And complex rules are envisaged for ETR calculation. I will take you through that in a very brief slide. And the entities themselves are not excluded, and some entities are excluded from the scope of this taxation. They are investment and pension funds, sovereign wealth funds, international non-profit bodies, international shipping, because they have an entirely different range or a rate or a method of taxation in many countries based on tonnage, etc. And what will be excluded also will be multinational enterprises in their initial phases of international activity. Now, this is still under development. So when you see the effective tax rule, this effective tax rule calculation will be done at the country level, consolidating all entities and branches that operate in that country. What will be seen is the numerator of local taxes paid, subsidiaries plus branches plus all withholding tax or controlled foreign corporation tax or any subject to tax rules payments. The denominator, obviously, as I said, is as per the parent's accounting standard, the profit before tax plus some minor adjustments. Once the computation is made, and if that falls below the minimum effective rate of tax, then there will be a top-up tax which will have to be levied. The potential simplification options under again consideration are that they may have a small de minimis profit exclusion to make sure that administrative and compliance time is not wasted on small entities. There will be perhaps a country by country effective tax rate safe harbor. There will be tax administrative guidance principles, etc. And finally, what is going to be the path ahead? Well, what the paper promises is that as early as October of this year, that is in less than 3 months, there is going to be a sign-off by 130 countries at least, and hopefully all 139 countries on the final rules. By end of 2021, that is by December, OECD will finalize model domestic rules, treaty rules, including the MLI, and all the associated guidance for, and they will put it out in public domain so that people can understand what is going to happen. In the entire 2022 calendar year, the multinational convention will have to be negotiated, signed, and ratified by many countries. Now, this is again an ambitious ask, because even today, out of the 95 countries that had originally ratified the first MLI, only about 65 countries have so far ratified, even though more than a year has passed since that first MLI. So we'll need to see what exactly is going to happen and how will countries comply with this. Then there will need to be domestic law modifications to comply with the new rules. But the big bang date given for full implementation of this is 2023. So with that, I will end here, but needless to add, we are in for exciting times. With that, Mr. Ranjan, may I now turn to you and discuss that what we have seen is, even as getting an agreement with 139 countries itself is such a huge challenge. personally speaking, as you have been keenly observing this and earlier were very much part of these discussions, do you believe that starting from the point of, early BEPS, 2015 taxation of digitalized businesses, then progressing to automated digital businesses and consumer, and now an omnibus tax of all MNEs satisfying just the 20 billion plus 10%, though probably only 100 top global companies will cover. Do you believe that the net result end of the day will be positive for a country like India? Or if it is difficult to give that clear answer, in this entire discussion, which you've been also a very active member of, what do you believe are the clear positives? And in your opinion, the areas that must be carefully watched by India from now on until, let's say, the final moment of time in which these rules will come into force. So over to you, Akhilesh ji. Please give us your context now.
Right. Thank you, Hitesh, and a very good evening to all of you in BCAS and others who are logged into this webinar. It's always a pleasure for me to be with all of you, with professionals who are discussing important topics of the day, and as I said, a most enjoyable experience. So Hitesh, I think your first question itself says it all. I mean, that's the crux of what's been happening in this pillar 1 and pillar 2. Yes, what we have now, what you had just explained in your presentation, what the agreement now looks like is something very different from what we had started off with. What we had started off with was the tax challenges of a digitalized economy. The challenges were because of certain specific features. The features were scale without mass, which means an enterprise could do a lot of business without having tangible assets on the ground. A heavy reliance on intangibles. And thirdly, an importance of user contribution, the data that users provide to the digital companies. These are the three distinguishing features which are supposed to raise challenges for taxation, and because of which the old traditional ways of taxing were not useful. What we have now, as you very rightly put it, is an omnibus thing. What we have now is merely an allocation mechanism which says that, all right, for the very largest companies and the most profitable companies, some part of their profits will be allocated to market jurisdictions, which was not being done under the existing transfer pricing rules. So essentially what has been achieved is a new way of allocating profits, going beyond standard transfer pricing. And for the purposes of taxing that allocated profit, a new nexus is being talked about, which will be dedicated for that purpose only. A new nexus not for any other purpose, but only for the purpose of taxing this additional profit that is allocated to market jurisdictions. So it's a sea change. It's a somewhere around the line we have lost sight of the main principles that we started off with, the main challenges that we are looking at. Now there is no talk of user contribution. There is no talk of data out there. It is assumed, everything is assumed that yes, if you have a large company, if you have high profits, then it is assumed that you are interacting with the market. It is assumed that you have some digital means by which you can reach out to customers directly without a physical presence. A lot of assumptions have been made. What really countries like India wanted, and what the developing countries wanted in the whole thing, was to have a real change in the way taxing rights are allocated. A real change in the balance between residence country taxation and source country taxation because of the digitalized economy. The change in the normal concept of a permanent establishment, which still talks about a fixed place of business. That fixed place is no longer relevant. That was the main base or the foundation on which all the discussion started. But now we don't have any alternate nexus. We only have an alternate way of allocating profits. Be that as it may, I think it's still a huge change in the tax architecture. Concepts which are unknown or unthought of earlier are now becoming a reality. The two main things which are good even from the Indian point of view and from the point of view of developing countries in line entirely with India's thinking. Firstly, that markets contribute to profits. This is one of the basic fundamental principles that India always said and advocated, that it is not just the production or the technology or the capital which creates profits. It is also the demand and the market and the sales which create the profits. And normal transfer pricing did not recognize these markets. They recognize marketing intangibles, yes, but marketing intangibles created by the producer, by the supplier, by the M&E, not by the market. So this is a sea change, that yes, now the mere fact that you are operating in a market at a certain high level means that you are interacting with the market, and the market forces are creating profits or a part of your profits. And therefore, there must be a right to tax. So that's in line with Indian thinking. The second thing being that we have gone beyond the arm's length standard. The arm's length standard is not working anymore in this digitalized economy. So it's now more of a formula-based approach. You consolidate profits in an entity. You don't follow this separate entity principle. That's a sea change. I mean, right up till now, it is understood that every entity in a multinational group is a separate entity, dealing at arm's length with each other. That concept has gone or is going. So it's now the whole profits, the whole group's profit all over the world. You consolidate that and then allocate it by means of a formula. Something on the lines of what our Rule 10 talks about in the income tax rules. It's a formula-based approach. So again, something which is in line with India's thinking, something which gives importance to the markets, to the countries which consume the services, the countries which use the products which are supplied. These countries are also now able to get some tax. These are the positives, but then India has to keep on with the discussions, remain vigilant on many things. You have explained how some issues are still not finalized. What is the profit allocation percentage? Is it 20% or 30% or something in between? What is that amount B? Amount B was supposed to compensate countries for normal routine activities. For some reason, it has been deferred to 2022 because there are problems in working out that allocation. That's something which developing countries were really looking forward to. And it's an area of prime concern for India and other developing countries. What is that amount B going to be like? Then there is this concept of there is something called a marketing and distribution safe harbor, which means that the residual profits will be allocated only if the existing taxation in that country is below that level. If you already have transfer pricing and you're already taxing the operation in that country above level, maybe no profits will be allocated. So India has to be careful and watch out how that safe harbor is to be worked out. And then we have to also note very carefully that India is an emerging economy. All that is agreed to will apply at some time or the other to Indian multinationals also. So it's not just India getting profits from other multinationals, it will also be Indian companies giving up their profits to other countries, and which will mean that India also loses some tax in the process. So that balance has to be achieved. And so these are the areas that we have to look at. So on the whole, a massive change in the way international tax operates, a very substantive change, and which has a lot of potential for the future. Not something which we wanted, we have expected, not up to that level, not something which makes us very happy, but something which gives us hope that yes, things are moving in the right direction, and something which does gives us some additional way of additional revenue and a way of taxing this new economy. So that's where we are, Hitesh.
Sir, I think you summed it up in a very balanced way. I think we were on a quest to, let's say, discover God, and maybe we've reached halfway and maybe discovered a place of pilgrimage right now where we are all parked. And that holy grail still continues, and a lot will depend on what actually rules they bring out. Sir, one of the things that I think India will need to be very, very clear about in its discussion is the solid nexus that is, enshrined in the new rules, so that tomorrow MNCs are not able to move away from that nexus and, shirk even the responsibilities of paying the residual profit. And that needs to be explicitly put out there in the regulations, which will come out between now and say October or December. Otherwise, my concern again is that, while this may sound like a great big deal, if you look at even except for these digital companies, and granted it will hit digital companies the most, the big giants of this world. In fact, most MNEs will struggle to have this 10% profit threshold. So even above that, we are going to get only say 20 to 30% of that too allocated on the basis of revenue. So even if, let's say, I were to count each individual on this planet as a user, India does not get more than 15% of that, being 1/6 of humanity. If, let's say, I were to extrapolate that everybody is a user of that particular MNE's services, India will not get more than, that 15%. And then I think when we compare with today's equalization levy collections, which are slowly but steadily trickling in, and now, in fact, we have, a big multinational already announcing that it's going to pass on this tax to the users. Fortunately, not in India, but overseas. So it's an interesting case study to see what will happen as the timeline unfolds and as these things become public. Sir, coming to your apprehension on Indian multinational enterprises, while right now the $20 billion turnover is quite high, 20 billion euro turnover is quite high. As far as profitability per se is concerned, I think most Indian companies will easily satisfy the 10%, because I think inherently, as I have learned in transfer pricing, the cost base in India is relatively far lower, leading to companies having much higher percentages of profitability. And if one were to just go on the percentage situation, I think India will, willy-nilly discover that it will have to give up revenues to other jurisdictions, as you are also apprehending. So it will be a delicate balance between both to see how this actually plays out. And that brings me logically to the next question is, when do you expect India to actually withdraw the equalization levy, and let's say, will it also withdraw the special economic presence in the domestic law which it has enacted?
That's a very interesting question and a very tricky question, Hitesh. Government of India has I think said on many occasions that it is looking for a lasting consensus solution, which should be a fair and equitable solution. And it has always said that, okay, in that case, we will then discontinue our equalization levy, which is always meant to be an interim measure. However, the developments that have happened, because now it's not a new principle that is coming up. It is just that some companies will allocate some of their profits. So this 20 billion euro will probably cover, the estimates are maybe less than 100 companies all over the world. It's only these 100 companies whose profits will some of those profits might come to India. But what about the thousands of others? If you even use a threshold of, let's say, 750 million euro, which is the threshold for country by country reporting, you have about 5,000 companies. That's what the profit should have come to India, but that's not coming. So now, with this partial allocation of profits, will India give up a policy decision of taxing all companies to a certain extent? This equalization levy applies to all above a threshold of, I think, a very small 1 crore or 2 crore threshold. So almost every multinational is getting taxed out here. Is that enough to say that, okay, just because 100 companies will pay some tax to me, I will give up my policy decision? So that's a tough question. The government will have to take a call on it. I think on revenue considerations, perhaps the estimates are not clear, but maybe we get some comparable amount of tax revenue. But then the main thing will be political, how we have to go along with the international community, and what the other countries also do with their own digital levy. There are 5 other countries which have imposed these of tax. So it's something to be seen what's happening in the future.
So very interesting, because this is really going to be the heart of everything. That end of the day, either by equalization levy or by this new tax, what is additionally the tax that is going to be collected? Let's move on, sir, to this pillar one. And again, you briefly touched upon it. Again, see, the only thing put out there, maybe for simplicity, is only the gross revenue. There is no mention, as you rightly said, of the users, the data, the other, synergy benefits, if you will have, of conducting this business in an environment which is fully digital and always 24/7 connected. That somewhere seems to have been completely lost. What is your take on that? Is it that we had to sacrifice this merely so that every country with the least common, denominator could understand simply, and therefore we said, okay, let's go ahead with this? Because, I think models are nowadays, and especially let's consider the big unicorns of tomorrow. It's possible, and this is historic, that Amazon has been consistently loss-making for so many years, even though it has a revenue which is in a multiple of $20 billion. How will we address that? Because that's a conscious strategy that the company is following to say, look, I'm going to be winning market share for me, winning market share, winning data, winning consumers, being the dominant force in everybody's life is of prime importance.
Very, very interesting, Hitesh. Yes, exactly. I mean, what we are achieving now doesn't really address the new business models that are there in the world. It doesn't solve the questions or give answers to the questions that were being raised and that still remain. These are the questions. I mean, what happens? What is the value of data? How does data contribute to profits? How do the number of customers or the number of users contribute to value? You rightly mentioned large corporations which do not have profits in their books, but whose valuations are sky high. We are seeing that every day in and day out. Who gets the value out of this? Who's benefiting from them? Why don't countries get some part of tax from that valuations? So these are questions which are still not being answered. What we have now, and the reason for this, what has happened is that actually the talks were not progressing. There was a stalemate, as you would be aware. As late as January of 2020, there was pessimism all around that the US was not part of the discussions. They had withdrawn, and nothing was happening. It's only because of US domestic tax policy within the new Biden administration that the US decided to give a push to the minimum tax proposal of Pillar 2. And as a SOP to other countries, developing countries, they said, okay, we'll also do something in Pillar 1. So that's the way things have panned out. Well, India had a choice of either just walking away or saying, okay, come on, I mean, something is happening. Let's take this and move forward. And I think that's the option that India has gone for, realizing that nothing really is possible just by being away from the international community. We will have to engage. We will have to consult. Things have to be done in a multilateral fashion, and that's why I think we are sort of at the moment happy or satisfied with what is happening out here.
Understand, sir. I can understand the compulsions and the pressures which must have been on the officers who were actually part of that. So, my heart goes out to them. This is not a easy task at all. And we have some outstanding officers, sir, earlier you and even currently we have some outstanding officers. So I'm sure they mean extremely well for our country. But it's just that the way this is panning out because of this huge consensus or the need to drive a consensus at any cost, which I'm little apprehensive might cost us little more than what we may have bargained for. That's my apprehension. So turning to these percentages, the October 20 said there will be a minimum of 20% of residual profit, which will, come to this. Now, suddenly there is a cap of 20 to 30%. So again, where do these percentages come from? How do you estimate that, let's say, if at all the market contribution is only 20% or 25% up to 30% of the residual profit? Are these just numbers tossed around and then finally pick something lucky number from a hat, or how does that, or there were any calculations? Can you share any process, any thought process?
Well, frankly, Hitesh, there were no calculations. These are ad hoc numbers. So this concept of residual profit itself, why residual? I mean, so who said that it should be in excess of 10%? Where did 10% come from? Nobody knows. It is an ad hoc figure. Does it mean that up to 10% profits, you don't benefit from the markets? I mean, is that a proposition? Maybe so, but it's just come out of nowhere. And then excess profit, the residual profits of that 20% or to 30%, that's the range now been decided. Which just sort of says that, okay, we can't give more than this. I mean, it's that sort of a thing. So being controlled by or driven by the US and other very large economies, they say that, all right, this is the maximum that we can think of allocating to markets. So it's a very rough and ready sort of things. Something like what our income tax tribunals did when they said that, marketing efforts will give you 35% attribution of profits. So
Rolls-Royce case, I remember.
So it's something like that. They said, okay, markets are 20%, 25%, not more than that. Fine. So then there's the answer.
Sir, you alluded to it already, that where is this hurdle of 10% coming from? Because honestly, if you ask me, even the top 100 companies, perhaps at a net level, overall on a consolidated basis, will not reach that 10%. So, these so-called, 100 companies, savior companies, as I call them, who will come and rescue our fiscal position that we are counting on, even that may not come through. Another question that I had is on a slightly related topic or the same topic in a different ways. What if overall the company doesn't make 10%, but from India, it is making much more than that? Then how does this, will there be a separate allocation, or will they say, no, since overall you are not satisfying the 10% rule, India gets nothing, even though it may be earning 50% from India?
Yeah, so that's one of the flaws in this sort of a very generalized approach. You're right, India will not get anything if the multinational has a lower profit than 10%. The only exception being, if it's possible to identify one segment of the company's business which has a more than 10% profitability. And that's where people are saying that companies like Amazon, as you had mentioned, Amazon has less than 10% overall profit. But there is a segment on cloud computing and all, which is far above 10%, and it's possible to identify that segment. So then that segment profits can be allocated. But otherwise, yes, I mean, even if the country is something is operating in India and is very profitable business in India, but overall there is loss or less than 10%, we don't get anything. And that's one of the flaws in this whole model of consolidated profits and this ad hoc way of saying what is residual profit and what is allocated profit.
So, sir, with that, now I come to this, as I said, the necessary conjunct with this is this whole question of mandatory, agreement or, dispute resolution measure, which in a sense is, like a carrot and stick. Okay, we are giving you this, but if you don't agree, we'll force you into mandatory, dispute resolution mechanism. What is your view on that? If there is genuinely let's say, even if today, let's say you comply with the rule, but say India after 3 years realizes that it is really not serving the purpose from which you had, taken up that challenge maybe 10 years ago, to really bring this to some sort of a logical conclusion. What is the recourse then if it binds itself to this mandatory dispute resolution mechanism, which seems to be very much enshrined as part of this entire concept as a package deal? Whether you like it or not, you have to take both parts of this package.
You're right, Hitesh. It is a package deal. In fact, the US and other large economies have always been very, very sensitive about the possibility of tax disputes. Now and that's the reason for their objection to having any other alternate to the permanent establishment. They think that if you have something like a significant economic presence, then countries like India will start imputing SEPs everywhere in the world or everywhere in India, and there will be massive disputes. So this has always been their concern that no, we can't give any more taxing rights, and if we do give, then there must be some very clear and binding dispute resolution mechanism. This was a pressure on India even during the earlier BEPS 1.0, as it is called. India did not agree. Thankfully, fortunately, we were able to persuade a lot of other countries also not to agree. So it wasn't made a minimum standard then. Now, in this new allocation, again there was an attempt that this should mean bringing in mandatory arbitration all over, not just amount A but everywhere. We have managed again to successfully stall it and say, okay, is restricted only to this amount A, and that also by ensuring that the model that they have now in the Pillar 1 document, you have seen the blueprint, that there are going to be two panels, and these panels will be comprised of tax officials, tax administrators, which is very different from having an arbitration panel which can be have any third party on it. So at least now we will be going to a panel for a dispute which has tax officers and who understand treaties, who know what India's stand is, and to that India has agreed to, and many countries have agreed to. But I think if there's any other further attempt to expand the scope of this mandatory process, then it will be very difficult for India to continue with that. And yes, we are sort of bound now, because if you try to tax more than what we're getting out here, straight away it'll land up in those mandatory dispute resolution panels. And in those panels, I don't think India will have any say on those matters there.
Sir, and a couple of questions I just saw on the chat box, and keep them rolling because we will take these up. Really, as we see it today, once the deal is signed off and we are committed to it, really, our experience will show us only a few years down the line whether this is really worked or not worked. And today, the way we bind ourselves, perhaps there does not seem to be any way to come out of that binding nature of the document, which, let's say, 130 odd countries at least will commit to bind and commit in their domestic law as well as in changing their treaties. What do you think should India do? Let's say, what would be the recourse available to India if, let's say, after 3 years or 5 years, it believes that, no, this is just not working? Because you bound yourself on the one hand, and what is the forum of justice, or what is the discussion point? Because again, see, today OECD has such a lot of momentum, and OECD's momentum has come only thanks to BEPS and all the noise that was created by chiefly the emerging economies, which were losing out their share of revenues. Again, I'm afraid after all this 23 successes announced and everybody is shouting from the rooftops, OECD will go back into its own slumber and they say, okay, we've devised a new system, everything is fine, why come back to us?
Yeah. Yes, precisely. So yes, we'll be signing a multilateral treaty. I mean, that's the way it is going to be implemented. And once you sign a multilateral treaty, then it's the same thing as, I mean, is it easy for India right now to come out of any of its bilateral treaties? It's not easy. I mean, you risk a lot of international criticism. You risk a lot of adverse consequences on trade, on other factors, on how you are operating. It's a globalized world. Already there is a lot of criticism of India not joining trade agreements, and how the way the world is going. I think we will have to be part of all such international agreements. So, in a way, the world is being driven in a certain fashion, where for which it is almost impossible for any single country to step out and say, no, I don't want this anymore. Because if it does that, then it's not just this deal that falls. There are so many other things, the trade relationships, which also fall. And that's something which India cannot afford. So I think we are in for it now. We can only hope that as time goes by, these issues will keep getting discussed. We will keep moving forward towards a more balanced distribution of taxing rights. And that's what India wanted. And somehow we have to keep building that pressure. We are enthused by the fact that, firstly, there are changes to the way of allocating income. So It's not arm's length pricing very strictly. We are now happy that people have realized that markets do contribute. So there is some positive development. We have to keep engaging with the community internationally and trying to keep pushing our case that no, something more is required. Something more is required. And now another positive point is that countries in other parts of the world are also speaking up. The African Tax Administration Forum, the Latin American Countries Forum, they're all talking, they're speaking up now, wanting further change. So I think that's how we'll have to look at it. We are stuck in a way, but let's try and make the most of it and try to move forward in the best possible way.
No, sir, you are absolutely right. If India reneges on any of its obligations, especially multilateral ones like this, it stands the risk of being an international pariah. Nobody will want to ever deal with us. That could be disastrous for our economy in more ways than one. And therefore, I think eternal vigilance is the price we will have to keep paying. As and when these rules are framed and as and when these discussions keep happening, and keep that spirit alive that, look, really, are we getting what, this whole question was about? So I think you raised, and I think, fortunately, at the very top, I'm so enthused that we have such capable officers who have a all-round understanding and really want to protect our interests, because ultimately it's going to be a situation where, the might of a nation is going to maybe drive some of these things. So in as constructive a way in which we can continue to raise the quality of the dialogue and appeal to somebody's sense of fairness or justice and get others to our line, I think India perhaps has that, path, a narrow and a very, very, let's say, rocky path, but it will have to keep following that.
That's right.
Sir, coming to this pillar 2, option that the press release speaks about, in giving countries the option to lower the trigger from 750 million euros to even a lower amount. What do you think would be India's stand so far as that is concerned? Because now, remember, it concerns its own corporates who perhaps are not paying, in the conventional way this pillar 2 is now worded, that effective rate of tax in the various jurisdictions that it is operating. Do you think India will bite the bullet and say, bring it down to 500 million or 200 million?
Hitesh, when I was still in service, we had tried to make some sort of an impact assessment of what is happening. And the basis for that can be the country by country reports. That's the only document where you know that what your own companies, there are about 100 plus Indian companies which are filing that country by country report, which means they have a 750 million euro plus turnover annual. We are trying to see, are they really parking profits in low tax jurisdictions? And we found that that was still not the case. Most Indian multinationals, when they're trying to increase their businesses, are actually going to countries like the US and to Europe. Our infotech companies, which are the major, largest Indian multinationals, have major sales in the US and in Europe. So that whole idea of, they haven't really probably evolved into that stage where they start using Cayman Islands or British Virgin Islands to park their intangibles. They still want their intangibles and their thing to be in India, for the income to flow into India, and taxes to be paid in India. So should we then lower the threshold? I mean, that's something we'll have to see. I mean, is it really worth it? I personally think that this 750 million euro is not going to give us any substantial additional revenue. Pillar 2 is not being of much use to India. It is something that, because the way Indian multinational businesses are structured, we will enact the income inclusion rule. We will enact the under tax payments rule, but we don't hope really to get much revenue out of it. So is there a point of reducing it further? That's something I think we'll have to see in time. How is Indian business operating? Are we really going out to that extent? Where are profits being parked? So at the moment, I don't think India will think of a lower threshold. I think they will stick with the 750. It's practically more convenient also because we can keep a check through the country by country reports. Otherwise, you'll have to devise a new system of information sharing. Some more reporting to be done by enterprises. We have one existing report which gives us information. I think we can continue to use that for some time.
Right. So I think it is encouraging, sir, that your experience showed you that really it is not that the Indian multinationals were in this game of, lowering effective tax rate by using either conduit companies or parking intangible property holding companies, etc. So that is encouraging, and therefore it does give hope that, India at least currently should not tamper with that 750. And you raise an important point of the data being available, because one of the challenges in, let's say, now, of course, we are moving to faceless and all of that and, electronic filing. But the challenge of gathering the right amount of data to apply a particular prescription also has been traditionally until now a challenge in India. So I think that 750 million, if it is not tampered with at this point in time, is still, very encouraging. Sir, another scope of the covered payments, for the subject to tax payments rules. There is still an open area which could perhaps have which is under negotiation, which could have a substantial impact. And the final agreement could, in fact, impact Indian structures, especially for, let's say, fees for technical services or capital gains, if they are explicitly brought within the scope and even made applicable to unrelated parties. So what's your thinking around that?
Yes, yes, that's the part of Pillar 2 with which India is really concerned. India and almost all developing countries. As I said, Pillar 2 does not benefit developing countries at all. You go area to Africa, to Latin America, and we don't have that many multinationals which are paying taxes or parking profits elsewhere. So, what does the developing world do? That was the ask. Then, okay, you give us a mechanism to at least prevent the erosion of our tax base. And that mechanism is a subject to tax rule. That, okay, we will, in a different way, we'll apply this minimum tax concept and ensure that the base eroding payments that are going to low tax jurisdictions, at least we'll be able to get some tax on that. Now, so it's very important to then identify the scope of the subject to tax rule. At the moment, it seems that the scope is limited to interest and royalties and those categories of payments that you mentioned. Of course, it's not too small. Interest and royalty, we already had a withholding tax in most treaties, but other payments like reinsurance premium, like franchise fees, these are things which are base eroding payments, and which I think will help us to get some tax if they are being paid to low tax jurisdictions. Low tax jurisdictions include places like Singapore and Mauritius. So it's a fact that many payments are big.
Bermuda is in fact the insurance center of the whole world.
Exactly. Reinsurance in Bermuda. Yes. So that will help. Plus, I think one of the major things that India has to sort out now, and is trying very hard, is to expand the scope of this STTR. Firstly, to capital gains, as you mentioned in the beginning. That's one part of thing. And more importantly, to payments of other things like fees for various such services, not just technical services.
Managed services.
Yes, shared costs, shared services, general services. There are so many such payments which are going out of India, which are eroding the tax base in India, and on which even transfer pricing is not working. We don't know how to control that. So those are the ones that India is most concerned with. At the moment, there is no agreement because there is distinction is being drawn between royalty and interest type payments and payments for fees or for services. You can say that if something is being done in the low tax jurisdiction, and therefore you are paying for it, that's a different matter. In royalty, nothing is being done. It's only an intangible parked out there, and therefore that's a different matter. So there is a room for discussion. India is trying very hard to expand its scope. If we can get all sorts of services in that fold, then the subject to tax rule will be a very useful rule, because there is no withholding on many of these payments. And that will be a net benefit for countries like India.
So actually, there is this tug of war, which is, really between the developed and developing nations overall, if you see in the scheme of things. Even as, being a practitioner, I do realize that when every sort of service is being brought within the withholding tax payment net, it tremendously increases the compliance burden. It's not just the tax, the compliance burden. And here, sir, unfortunately, I have to voice this unpopular, sentence, that the poor taxpayer is loaded with all sorts of compliances today, and with no upside, but all the downsides visiting him. Should he even miss filing a form on a particular day, there is a penalty to that. So that is something which I think as part of this overall package, if let's say more and more services are brought in, my only earnest appeal to you and, to the powers that be who are listening, that at least simplify the compliances burden, relieve the taxpayers from doing what is now otherwise available to you electronically. You see all your payments, everything, you require all the forms, etc. And yet you want a withholding tax to be discharged by the payer, often, at his own peril. So that's something which needs to be woven in to reduce the compliance burden. While, conceptually India may have a position on including all services, I think somewhere the taxpayer also needs to be looked at in terms of the burden that he will continue to bear.
No, absolutely. Absolutely. I think that's a very important point. And it is a key consideration. The subject to tax rule is still to be devised. Now, there is work being done on how to devise that with built-in thresholds. The way to remove or reduce compliance issues is to build in thresholds. And there are two types of, again, thresholds. The materiality threshold, which will mean that is this amount of profit or amount of payment really worth all this effort? I mean, how much of the company's total expenses is this part of it? And secondly, things like if there's a low return to that in that low tax jurisdictions on the payment, then are we really concerned? There are different types of thresholds which are being contemplated. So yes, but then there must be, otherwise it will be maddening. There are thousands, like hundreds of thousands of payments being made by Indian companies, and then how will we monitor all that? How will the companies themselves give you information on those things? It's absolutely maddening. So a very strong set of thresholds will have to be built in to concentrate on the really worthwhile payments that in this rule.
And I can't help remarking that we've just had a horrible experience just now with the TDS and TCS provisions which have become law this year. I mean, the challenges that people face, because see, imagine a company which has 1 million transactions a month. You can never do this manually. You'll have to rejig your whole systems with its own bugs, etc. And for that system to stabilize. And again, sir, there is no guarantee. Next year, again, the rate might change or some other thing may tweak it such that the whole thing becomes non-operative. So, my appeal is that at least compliance burden should be relieved definitely from all of this. Turning slightly, sir, what happens to, the India's highly successful, and I know you have been a big contributor, the APA program. Do you think, that also will now have to be sort of at least retuned, repurposed to take into account these new challenges and these new developments?
Yes, I mean, there could be some impact on the APA thing. Of course, I mean, and particularly now that we have expanded the scope of the APA to cover profit attribution cases. In those attribution cases, definitely the new developments will play a large role. And our way of approaching the APA, of negotiating an APA for attribution, will be guided largely. Of course, we already have Rule 10, which is the basis for that sort of attribution. But now with this added support from the Pillar 1, I think we'll have more of a say in doing a formula-based allocation rather than pure transfer pricing. On the normal regular APAs, which are essentially trying to find the arm's length price, I think that may not be much impacted really. I think because there is no real change being made in the arm's length standard or in the principles of traditional transfer pricing. So I think that should remain. Of course, there are things like low risk distributors or captive contract manufacturers. These are types of entities where a fresh view might be taken that it's not just completely captive, it's not just low risk. There is something more to it. It's part of a group, and there may be some impact or some influence of this formula-based approach even there, but then in the negotiation part of it, but not substantially, I think. But for profit allocation and attribution, definitely, it will be something that will impact.
The tricky ones, like, say the advertising and marketing intangibles, etc., they are squarely in that, cross eye, if you will, of this very change. And therefore, I think revenue may need to be accommodative of what new changes it is anyway going to sign up to, and what kind of a precedent will that be for the past APAs, because many of these are still not signed and they cover periods much in advance of what these developments are going to take place.
That's true, yes, because we have always been saying in our APA that this point about the markets playing an important role. And wherever, because I mean, you come to the arm's length thing later, but first you say how much income should you leave in India? That's the first thing. so that is something which will be guided more now by these, supported by these new developments. In fact, you say that no, markets do play a role. We don't have to convince the multinationals that there is something in the market.
And sir, it will cut both ways, because there will be people who will say, but I'm not even 10% profitable. So where's the question of any allocation? So,
that's true.
That's the other side of it. So I think, most companies will need to be alert and alive, not only in a theoretical sense, but some of these APAs, it will have a direct bearing on, is what message I think we should give today, that it's very timely that we are discussing all these matters, because these are not theory. This will come into play in even existing matters.
Yes.
So one of the countries which has objected to this or not yet signed up for this is Ireland. And by now it is well known that Ireland has been, let's say, the darling of many or most of these companies. So what is your take? Will it ever sign up? And if not, how effective? And what will the international, let's say, inclusive framework body do if, let's say, eventually it just refuses?
So the objection of countries like Ireland is not to Pillar 1. So Pillar 1, there is wide consensus. But to Pillar 2, yes, of course, but that's what hits countries like Ireland. And that's why consensus is not necessary for Pillar 2. It's entirely up to countries whether they want to enact or not. But if they do enact these rules, then it will have to be in a consistent fashion. Now, there will be many other countries like Ireland, which also do not want to enact these income inclusion rules. Of course, for that, there is this undertax payment rule, which will still ensure that low tax entities in that group, which is headed by Ireland or whatever, still there is a tax on top of tax levied on those entities. These countries, however, will be in a fix now to what do they do? Do they increase their tax rates? That I don't see happening, because I mean it's then be an admission of that of lack of sovereignty, that I am not in control of my tax rate. I think they will continue to maintain their tax rate. They will have to find new positives to still attract the investment that they were attracting earlier. Countries like Mauritius and all UAE are already on the job. They are trying to build in more transparency, build in better regulations, regulatory systems, and ease of doing business in different ways, which will not have a tax impact. And I think that's where these countries will now concentrate on, leaving their tax rates not unchanged. I think that's the way they will deal.
I have a feeling, sir, they will take recourse to increasing the indirect rates of tax, indirect tax rates, to supplement revenues. Because, if tomorrow, let's say, if the world were to move away, let's say, even from a fossil fuel economy, all these economies are in very big danger of suddenly collapsing unless there is a sustainable revenue base. And suppose, what they will discover to their peril is that not only will they find it difficult to increase their rates because of the explicit promises they have given in the past, but now they will see that other countries are taking advantage by taking away that share of tax for themselves. So it's a really hard kind of call that they will need to take, isn't it?
Yes, it's actually not fair. A country should be able to decide how much it wants to tax someone. and then to say that, okay, if you don't tax it, I will tax. That's sort of putting salt in the wounds. So yeah, it's going to be tough for all these countries. And yes, I see a lot of change happening. You're right. I mean, next 10 years, there is not just this, there are so many other considerations. And very correctly pointed out by you, you have to have sustainable revenues. That's the new goal now. You have to have sustainable development and sustainable revenue. We have the ESG standards or the agenda coming up, which will now require countries to maintain a sort of a fair system where you have your revenues in place. So how will the other going to do it? They are going to have to change the way they operate, and the economic models might have to change.
Sir, I will take up a few questions from the audience because, our chat boxes are flooded. Do you expect India now to move to the concept of consolidate return for group entities? Because, eventually everything has to be looked at from a consolidated revenue perspective. So will India now think at least that we need to go down that path?
This issue has been under discussion for some time. Till now, I don't think there's any concrete move or proposal to move to that system of consolidated filing or consolidated payment of taxes. And I think for the same reasons as, when I talked about Pillar 2, and I said it might not really impact many multinationals, so we won't tinker with the threshold. I think we may not at this stage tinker with the current setup. It is certainly something on the horizon, something which is a possibility, something where countries would have to move at some stage or the other. And but I think at the moment there is no real need, it seems, for us to move to a system of consolidated filing and consolidated payment of taxes. It doesn't change much. It also doesn't change the way the compliance mechanism works. And I think for such a big change, we'll have to also change a whole lot of systems that have been built in.
Right. So you don't see that in the near future as a near future change?
I don't think so. I don't see that.
Okay. Sir, another question which is very much germane to India, which is this whole concept that we have introduced post Vodafone retroactively, is this concept of indirect transfer provisions in our law. Now, let's say in the subject to tax payments through Pillar 2, you introduce capital gains. Will these also now extend to indirect transfers? And if so, how will that be monitored? And, it's quite a...
Yes. Yes. So that's there are lots of discussions that are going on. It has not been spelled out in that statement as to what really is happening. They just say that some issues are being talked about in capital gains. But yes, I think this is a very relevant issue, and this issue itself is something. I mean, we may have picked it up long ago in 2007, but now it is bothering countries around the world. I mean, it's something on which there is a platform on collaboration on tax. IMF, World Bank, they have come out with a paper on it. There is talk in the G24, the developing nations groups, how to address it. Everybody is bothered about, and it is a major problem with all developing countries that of offshore indirect transfers. So the UN, in fact, is now bringing out a change in the UN Model Convention. There'll be now a paragraph dealing with indirect offshore transfers, which will allow the country where the assets are located to be able to tax the capital gains. So, so I think it's something which is on the cards, particularly because of the UN development. The UN has announced already that the new model convention will incorporate this paragraph. So I think it's something that could be. It's very difficult to structure under a subject to tax rule. What payment are we talking about there? If there's a withholding mechanism. Where, on whom? So how do you tax it? How do you tax it? Yes, it fits in the principle, but in practice, in this model, how does it work? So that may be a major stumbling block. But it's something which is certainly being discussed, and I'm sure it'll be on the agenda.
Again, we have to watch out for what provisions actually are spelled out so far as capital gains, if at all it's included, and therefore how will it affect indirect taxation is also an area to be which I'm sure tax professionals will have to keep an open eye for. Sir, one of the questions or points being raised is the fundamental premise of BEPS is the shared fear of revenue loss by nations, right? I mean, that's the whole driver. Now, if implemented, let's say, do you think the revenue departments of nations are likely to be in conflict? And of course, we mentioned about the mandatory dispute resolution and conflict on their respective rights to tax. And that may unfortunately see what I have seen is when elephants fight, sometimes the lesser animals get trampled. If revenue departments fight, will taxpayers suffer in such a situation? That's another apprehension which is being voiced today. That while it is true that everybody announces success from the rooftops, have you considered the person from whom eventually this payment has to be collected?
No, yes, absolutely. So that's one of the major areas of work which is still going on at the moment. In how will you eliminate double taxation? So precisely this. If some profits are coming to India, where are these profits coming from? Who is giving up those profits has to be decided. There has to be a system to say that okay, these so and so countries will then give up their tax, and then how will the credit mechanism work? So that is a huge area of work that will have to be, and I don't understand how they're going to do it by October or by December. It's something which is massive, and the ideas are there, but how do you implement that into that? And it will have to form part of the multilateral instrument. Only then will it work. So that's going to be a major area, and yes, there will be disputes, and that's why I think we need additional mechanisms. One, of course, it is binding resolution mechanisms that have been talked about, but things like an international compliance assurance program of the OECD, which is a sort of a multilateral APA or something like that. Beforehand, before the transaction happens, there is an understanding between the taxpayers and the concerned countries that this is how the profits will be allocated. That's an idealistic picture because one multinational may be operating in 100 countries. You can't get 100 countries to sit together in a table and decide how will the profit be allocated. But that's something that has to be tried. Those are the mechanisms that have to be thought of. So even this dispute resolution, the whole concept, I think, is going to change. We're going to see more emphasis on preventive measures like the ICAPs, the compliance assurance programs, and the multilateral APAs. These are the things that will come in more and more, because otherwise there's going to be, as I said, going to be a lot of disputes, a lot of confusion amongst countries.
Sir, you'll have to build in audit mechanisms because, it's one thing to say, okay, but people are human, they may make mistakes. So you may have to devise AI and ML programs to actually compute this tax and allocation and all of that, because you can't sit manually around the table and 100 countries say, okay, this is yours or this is mine. Plus audit, plus, some mechanism to, take back or give back something which may have, flowed over in excess or in shortage. So all these mechanisms also, that's the nitty-gritty, but will have to be thought of it if this has to succeed.
That's right. That's right. I mean, it takes a lot of doing, and it's very, very easy to say that we will implement everything by 2023. But I think it's going to take another 5 years for things to stabilize.
Let me just share with you one question, which is so typical of what a Bombay Chartered Accountant audience wants to hear. So this question is so simple. Is there clarity on whether equalization levy will be part of the numerator for calculating the ETR? Now, see, we have said equalization levy is not even a tax. Conceptually, right? You're enacted as part of some finance act. But I think, this is the kind of detail that people are looking for. Whereas I don't know whether the systems are geared up in such a way that by 2021 or even 2022, such level of detail can be actually devised.
Yes, so there are a number of such details. Exactly. Is equalization levy a tax to be considered? Is that tax only the tax as per the treaties, or is it all types of tax? Is it indirect tax also? there are many questions which are remaining to answer, and that's why very, very ambitious program. I know that a lot of work has been done in the OECD. I have been involved in that work for quite some time. I know there is a massive amount of work done. The blueprint itself came out in October, shows the amount of labor that has gone in. They have really considered a whole lot of things. But to put all that together now and filling the gaps by December is a huge task. And I really wish them well. And now how they're going to do it.
So on that note, I think we should end by hoping and praying that all will be well and it will end well. So I hand it over to Mihir and Abhay. But thank you. It has been an absolute privilege and a pleasure talking to you, sir.
Thank you very much. Very interesting discussion.
Thank you, Mr. Akhilesh Ranjan. Before concluding, just some of my thoughts and the remarks on your excellent session, sir. First of all, Hitesh bhai, he took us through the basics of Pillar 1 and Pillar 2. They were excellently and in simplified manner explained to commence the conversation with Mr. Akhilesh Ranjan. That was really nice of you, Hitesh bhai. Coming to Akhilesh Ranjan ji, sir, you have highlighted that it is a new way of allocating profits for taxing in various jurisdictions where the enterprises operate. And you have also brought to light a massive change from the way international taxation regime now operates. It was indeed heartening to note that two main concepts which India was advocating are cornerstones of the new tax regime, namely that markets contributes to the profits and taxation goes beyond the arm's length pricing. And in fact, there has to be, because there is much more than arm's length pricing which goes into the transactions. Further, sir, you also provided perspective of India's stand on revenue consideration by comparing taxes which may be collected through the new tax regime of Pillar 1 and 2 vis-a-vis those through equalization levy which is being currently collected. So there are concerns on that, and you have highlighted those concerns to us also. You also highlighted that the new tax regime does not address the taxing of enterprises operating in technology-driven businesses which make losses and have different penetration models for entering multiple countries. So I think all in all, there were many thought-provoking ideas which are there, which has gone in, what you can say, finalizing Pillar 1 and Pillar 2. And there will be a lot of learning that we will have to go through. There will be many unlearnings and learnings that we have to go through now in future, and for which this session will be really of great help to us. And before we end the session, I will request Mihir bhai, Shet, Vice President, to propose a very well-deserved vote of thanks to both of you, sir.
Thank you, Abhay. Before I give this well-deserved vote of thanks to both of you, let me put out few events which are forthcoming in the month of August. On between 12th and 16th of August, there's this 25th International Tax and Finance Conference. Between 1st April 2021 to 31st March 2022, which is a course of forensic accounting and investigation studies. On the 3rd and 4th weekend of August, there is a corporate convention. Between 17th August and 25th September, there's a 4th long duration course on GST. And there are two events arranged by Managing Committee on the Economy. The first one is on the 18th of August. That is on evaluation of stocks, new economy versus old economy, local and global investing. And on the 25th of August, there's a GDP and economic analysis, perspective and importance for CS. And now let me do this honor of giving well-deserved vote of thanks to both of you. Starting with Mr. Ranjan. Sir, we are living in a complex world, and obviously the fact is that there is a very complex web of laws which are enveloping us on an evolving basis. The challenge is, how do you interpret these laws and this regime which operates on your economy and put it across simply? And I think you really done this so wonderfully. I'm only reminded of a quote which said that the sound knowledge, the proof of sound knowledge is not what you gather in your mind, but it is how you can disseminate to a person not as privileged. And I consider myself very underprivileged when, I, as a novice, because I'm not into this practice, but even while listening to this, I can understand the enormity of this subject and how you really put it in simple terms. You explained what are the clear positives of this pillar 1 and pillar 2. You have also explained how things will be different in the new regime of tax from what we are used to really operating within, how transfer pricing and equalization levy concepts will undergo a change, whether it will remain even as a numerator or whether it will just go. That's a thing for us to really now speculate. The whole, as we understand that the whole tax regime will now be on the market-driven economy, how these markets will be segmented, how the profits will be really interpreted, on what ratios. All these are the things which you put it in such simple terms that I think it's a great treat. So thank you very much, sir. We are really privileged to have people like you coming to us with such experience, such seniority, and such exposure that I can consider ourselves and BCAS lucky to be having privilege of honoring and hosting you.
Thank you.
Hitesh, I don't know whether to thank you because you are a part of us. We have all grown together and you've been always, in spite of your busy schedule, always available to BCAS, sharing all this knowledge that you've gathered, the skills that you've really gathered. And it's always, I can not only say that as a friend, but even as an official from BCAS, I can say that it's really wonderful to on board here and to talk to somebody, as intellectual as Mr. Ranjan. So thank you, sir. It's an honor, and we look forward to having this once again as the things evolve. Thank you very much.
Thank you. Thank you.
Thank you, sir. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you. Right. Bye-bye.